Welcome here at our next webinar at JFD Bank, and have a good evening, I have to say. And I got already a couple of greetings here in the chat. Yeah, my name, thank you for that. My name Stefan Friedrichowski, as always, for those kind of webinars. And it's a pleasure for me to have you all here. If I look to the names, it really looks quite international, but I have no idea how well I am in estimating from the name to the country where you're coming from. Maybe you just write a line here in the chat about your home country. It looks a little bit like UK, Spain, Italy, I think. Yeah, maybe Bulgarian. I'm not sure. So, but there are really a lot of names. Oh yeah, so Spain was definitely not correct. You hear me laughing. Um, but yeah, country-wise, it would be okay, but I have to admit there is a special region, and sorry for that. Uh, I think you don't misunderstand me. So the reason is there's somebody writing, I'm a Catalan. So, and that's not Spain. Okay. Good for that. Anyhow, what's the date? Yeah, we have the 12th of December 2019, 7 o'clock p.m. And yeah, Trading the Edge. That's the title of today. And honestly, the webinar is much more conceptual than you may expect. So finally, there's not a complete trading strategy at the end. It's more conceptual in the way that we talk about edge and how to derive an edge, and about a new concept for that. You will see during the webinar. So nevertheless, at the end, we will have already some hints about general rules for trading as well. But it's not a complete trading strategy. It's more the first step. And on the final page, you will find a sentence, there's more to come. Yeah, that's correct. But we need that preparation, and I hope you like those kind of webinars as well. Not that many charts, a little bit more Excel sheets and investigations looking to the results which came out of other computer programs. In this case, it's C++, doing the analysis because it's millions of trades and millions of candles being investigated, drawing the right conclusions. Hopefully, let's see. So the slides for today's webinar, they are already available via the GoToWebinar control panel. And if you have later interest in the shown Excel sheets, no problem. You see my email address, and it's really with my complicated last name, s.friedrichowski@jfdbank.com. So, and just call me Stefan. Yeah, that's fair enough. Before I really start, the procedure, I have always to show up once during a webinar, the so-called risk disclaimer, because we talk about trading, we talk about investments, trading strategies, entries, exits, things like that. But of course, finally, when it comes to your trading, you do everything on your own responsibility. I think it's quite self-explaining, but anyhow, it has to be mentioned during a webinar at least once. Done. Let's look to the topics of today. So a little bit, I have to say it would be, or it is good, if you may have a look to the last webinar about trading and statistics, because that was already, it gave us some hints that we need huge statistics in order to be reliable. And you find that webinar on the JFD YouTube channel. That would be exactly the keywords to enter at Google, and then you will find the recordings of that webinar as well. The question about reliability and real probability advantages? Yeah, that's a quite important question when it comes to trading. And even that is not everything. As you know, having an edge is not enough. We always need an edge, including costs, finally. So even if we have an edge, so let's say we have a probability advantage of 50.1%, no, uh, it will be not enough, be sure, because there are additionally the costs of trading. So only if you would have something like that after costs, then it would be a profitable trading strategy. And then we came to the conclusion, maybe. And the reason is maybe our statistics is not good enough in terms of we have not enough numbers, counts within our statistics. So just for example, if you would show me a trading result, maybe from your own account with, let's say, 100 trades, and those trades finally go north, I would do an analysis about your hit rate, your expectation value per trade. And finally, maybe I would have to admit, okay, good result, congratulations, but I don't know really whether that might be go on. Okay, we have no idea about the future at all, that we know. I think that's quite well known. But even from a statistical point of view, that kind of statistic might be not reliable enough. So that's the reason why I mention here reliable edges. And the new developed concept here is finally that we combine all the symbols. We investigate just the Forex universe simultaneously. And we do it stepwise. You will see the steps. And just in order to get better statistics. And I will illustrate what I'm talking and doing here with a couple of indicators, trying to find out what kind of edge do we have within those indicators. Okay. I mentioned already last webinar, and therefore I have just 3 lines here about the findings of last webinar trading statistics. And the maybe most important result is here in the first line. If I want to know the hit rate with a precision of plus minus 2%, just from a statistical point of view, I would need 5,000 trades. Okay, I don't go further down how I derived those numbers, and still it might be just from a calculation point of view that we say, okay, 4,000 would be enough already, but just to have a rough estimate. So 5,000, that order of magnitude. And I know that already that kind of statement is a little bit disappointing when we look to our trading results in our real life accounts. And even if they go north, it might be just an exception, so to say. So if we want to have real good measurement, and you know I'm a physician, so I talk about precision, I talk about measurements. Yeah, we would need, for a measurement of plus minus 2%, we would need 5,000 trades. And now let's compare just with number of candles, if we look for historical data. And if you look for 1 year H1, so hourly candles, then we would have 6,000 candles. And in most cases, my historical data, they start at 2004. And therefore, I have 15 years. Okay, that would multiply to 90,000 candles. But now, that's other candles. Think about any kind of trading strategy, whatever the entry and exit rules are. But let's assume we trade every 24th candle. Since I'm talking about H1, that would be 1 trade a day. Okay. Then we would have, for the last 15 years, we would have 3,750 trades. Sounds like a huge number, but comparing to statistics, if we want to have measurement of our hit rate was plus minus 2%, still not enough. That's our dilemma, so to say. And now I have a workaround. And the workaround is that we investigate that kind of edge of our trading strategy simultaneously, for example, for 28 forex pairs, because that will multiply the number of candles and the number of potential trades. And then we might have a good enough statistic. So we have enough trades being executed, let's say via backtesting, and that is a little bit of workaround. But now we have a problem. Since the forex pairs, or if you look in detail to the pairs itself, they have totally different costs. At JFD, okay, we have always the same commission, but the spreads are widely spread. So we have lots of different numbers, maybe 0.3 bips for euro US dollar, and maybe we have 3 bips for British pound and New Zealand dollar. So we cannot expect that every pair can be treated the same. And therefore, we have another workaround. Let's see it for that. You may think, okay, we can have much more candles. Let's go down the road to M5 data or tick data. Then at least we have much more data points. But the question is, do we gain additional information? And my personal answer to that is, unfortunately, not. I will not give you a real mathematical answer to that. I just want to illustrate that in a chart. So let me jump to a chart. And now let's focus on two charts here. And that is on the right lower corner, Euro Swiss franc and Euro US dollar. And you see that I have drawn two lines in both charts. And those two red lines, they have a distance of 100 points or 10 bips. And now let's assume that I typically trade with 0.01 lot. Okay, and then those two lines would reflect a 1 euro distance. It's not really correct. That would be really 1 euro if euro Swiss franc would be at parity, so not at 1.09. Same for US dollar, which is 1.11. But anyhow, so it would be a little bit less. Let's still call it 1 euro. So you see, we have here M5 candles, and sometimes it takes 40 candles until we reach out significantly from that 1 euro distance. So what do I mean with that? So if I would open a trade here at my current position of the cursor, or maybe 15 candles later here, it's still the same level. So if I would open trades with a fixed stop loss and a fixed take profit, finally those both trades would more or less behave the same. So there is no information gain with a lot of candles. That's different if we have, like today, we have interest rate decisions, then okay, there's much more moves in the market. Then we leave the 1 euro distance line here, on more or less short term. But anyhow, it doesn't really help to go down the road, even to tick data, because if the price is not changing, we have still the same situation. The only exception might be that you say, okay, the information I have here, if I don't leave that distance since 30 candles, okay, then I know since 2.5 hours there is no new situation. But I don't know whether that's really a new information. Anyhow, that's the reason why just going down time frames doesn't really help. Okay, and the real new concept here is, okay, that we investigate forex pairs in a starting position simultaneously. And what I normally do is always I look for 28 forex pairs, and that is simply all combination you can build out of those 8 currencies, Australian dollar, Canadian dollar, until US dollar. And yeah, that sums up to 28 forex pairs, because we have only, let's say, one direction. We have Australian dollar, US dollar, and US dollar, Australian dollar. First thing, we cannot trade because that is not a valid symbol. And on the other hand, it's nothing new. I mean, that's just the other way around. So one divided by the other is always the same. So no, it would be nothing new. So there are 28 forex pairs. Finally, that is a concept. On the next slide, I will show you what we do today. So the starting point of any investigation in order to find edges will be that we do trades within those 28 forex pairs, but we will switch off the spread. And I still will use the commission. Why? Because the commission is the same for all symbols mentioned. Okay, but the spread, is totally different for the different symbols. So, but on the other hand, if we switch the spread off, then we have the same situation for all pairs. That's good. Now think about, we found something for a trading strategy which works really well without spreads, which is much more easy than with spreads, I know. But then we have behind us the statistics of 28 pairs. Wow, that is, so we can increase our statistics doing that kind of procedure. Then afterwards, in a second step, we will switch on the spread and we will look for the different forex pairs individually. The idea behind this, it might be that we have a good strategy, but only because maybe the spread for British pound, New Zealand dollar is simply much higher than for euro, US dollar, the strategy might not work with that one. And believe me, costs of trading is more or less everything. So it's really important. And if they are different for different forex pairs, we have to include that finally. But from the development of the trading strategy, we could use even those British pound New Zealand dollar trades, but then we have to equal all the trades. That means, therefore, we start without any spread. And that the spread is really that different, let me illustrate that as well. Going again here, and now I need another MT4. What you see here, because I'm always logging all the spreads, just to know those numbers quite well, even versus time. And I don't want to go into the details. That's, by the way, because yesterday in the German webinar, I got a question, what kind of indicator I'm using here, because it's an indicator. And the name of that indicator is ICE FX Spread Monitor. And you can find that with a Google search, and you may include that in charts at your own as well. If we just look for the big number here, then we see currently the euro US dollar spread is 0.3 bips. And let's compare it with the number below, which is British pound, Australian dollar, and you see we have 3.9 bips. So that's really a huge difference. And since costs are extremely important for our trading activities, because we have only small edges and costs can ruin any trading strategy. It's not a surprise that maybe a quite well doing strategy on euro, US dollar doesn't work on British pound, Australian dollar, simply because of the spread. Believe me, that is really extremely important. And we have done those kind of calculations in other webinars, which demonstrate that kind of behavior quite well. So we have really quite different spreads here, and it might be that we have already now higher spreads on British pounds, forex pairs, simply because we have a special day, elections in United Kingdom, and maybe they will further increase. I don't know. Let's see. So spreads are really different, but from a development point of view, we can first start without spreads and later putting them back into the game. Good. That was the final concept. What I'm doing here today is a little bit different, and what is a little bit different here today, and I do it simply because of let's call it didactical, or is that an English word? I don't know. From education point of view, it's a better way to start a little bit different. And I start still with the 28 forex pairs, but I will guide you through the procedure. First thing is I will just investigate the hit rate. The hit rate. So I even will not ask about trades in terms of how much profit or something like that. No, we will open trades in a simulation and wait for example 3 candles. So we go 3 candles into the future, and if that trade would have been a long trade, and if the price is above our entry price, then I call it a hit, a positive trade. So I just ask, did we predict the sign of the trade or of that move correct? Yes and no. Next step is, let's really look to the percentage move. So how much percentage of that price we would have as profit. And then in the next step, I will switch on the spread and the commission, but I will do it for all, not individual. I will do it for all in one step, and let's see how much we will lose simply because of we switch on the spread for all. So that's different from the final concept. But what I call the final concept is the one I further go down the road. Simply, I'm already ongoing with developing strategies on that kind of concept, which is really quite promising, I can tell you. But now I want to talk about edges. So we need something as an additional input. And what we will investigate is simply the edge of different indicators. Okay, oh, there's a spelling error. No, anyhow, let me correct that. So, there's another one. My God, separately. So, now we have it. So we will investigate different indicators, because indicators might help us to find good trades. As always, you may have indicators in your chart as well. But now, let's go for what kind of indicators we will investigate. So let's start with that one here. With a list of different indicators I'm investigating and show results for that. And I will start with the rate of change, the ROC. Sometimes that indicator is also called momentum. And it's simply the question, if we look back 10 candles, then we have a percentage move between 10 candles back and close price of last candle. And that is simply the rate of change. So it's more or less the quite easy indicator, but it will tell us already a lot of things. I will always do things here in percent. Simple reason. We have euro, Japanese yen, and we have euro, US dollar, and other pairs, but they have totally different base prices. So we should do everything in percent, of course. And all those indicators have a period, like my example, what was my number? Anyhow, let's say I look back 24 candles, then that the period in H1 would be 24. We might look 50 candles back or 100 candles back or only one candle back. So any indicator has always one degree of freedom, and that's its period. So we will look for different periods of those indicators. Other indicators I investigate is, for example, regression percent. That's quite simple. If you look for the price and for the last 100 candles, you can fit a regression line into that points, and that regression line has a slope. And yeah, that slope might be a good indicator as well. Or we go for the distance to a given EMA. So if you would have an EMA 15, and then the actual price has a percentage distance to that EMA, and that might be a good hint for, or good indicator as well. Slope EMA, quite easy once again. It's the same EMA, but now we measure the slope. And finally, I have an indicator which I personally call range position. And let me illustrate that indicator because I don't have it in MT4, but in my when I compute everything, I can of course do it. And let me go here in that chart. And what I do, for example, range position for let's say 1 to about 10 candles. What it means is I would draw two lines here, 10 candles back. Within those 10 candles back, I would draw a line for the maximum. I would draw a line for the minimum. And now I have a position within that range. So if I would be exactly at the upper limit, it would be I call it 100%, at the lower end 0%. So I have simply a number between 0 and 100, and that is what I call range position. So the idea behind, so I look at certain numbers of candles backwards, and maybe if I'm already at the edge, at the 100 or the 0 level, so I'm close to maybe breaking out, and that might be a good edge for trades as well. So, but up to now, everything is a question mark. But now we need something else. We have we have historical data for 28 forex pairs, and we have those kind of indicators. But we want to group them, not the indicators, but the values. So let me explain what I really mean. So for a given indicator with a given period, we can have we have thousands of different numbers. Okay, and now we will create a histogram out of that in order to group them. You will, in a minute, I will show you exactly what I mean, and then I hope everything will come clear. In order to have less data, I will do the illustration on Euro US dollar D1 simply because I don't want to have 90,000 values. I have only about 4,000 values. But just to illustrate what I mean with that histogram and grouping those values. We have here the price data of Euro US dollar, the different candles, and I have created the rate of change 24. Okay, that means I have here simply the difference between that close price, 24 candles backwards, divided by the actual close price. And anyhow, if I would divide by this number or that number, mathematically it's different, of course, but from our grouping perspective, it will have not such a huge impact. So that's one indicator, rate of change for a given period, 24 values calculated, and now here is already the graph of those different indicators. One side remark here, because we immediately can see something like the overall volatility here. And you see that financial crisis, we have huge bars here. And as we speak, the last couple of weeks and months, only small values. That's the reason why trading is a little bit more difficult in the last couple of days and months and weeks. But anyhow, so that's the rate of change. But now what I can do is I can take all those values, mark them, and I will go for another sheet and I will copy them here just as they are. And then the next will be I order all those numbers in ascending order. Okay, here we have them. And now I can plot them. I will do. And then I will explain what's in the other graph. So here we have all those values. And that kind of graph I personally call a pseudo-histogram. Normally those histograms are bell-shaped curves, and of course they are, and would be for that example as well. So what we can see already, we have only a few extreme values, because here we have all the values and here the values itself. And we have lots of values in the range around 0. And if I would really draw a histogram, it would become more clear, but that would take a time. But what I've now been doing is simply, I put out those values, and that is already prepared here. If you see what I've done, the first one goes for the lowest value within our complete 4,000 different values. Okay, that's the lower end of that group. And now you see equals A about 430. What does it mean? Here we have about 4,300 different values, and I want to have 10 groups, and therefore my group with 430 values ends here. That means if I look for the range, a rate of change 24 indicator, my extreme group to the left with very low numbers is between minus 0.17 and minus 0.036. And then the next group goes until here, here, and so on and so forth. So the good thing is, within one group, I have always the same number of members, same number of days or values. So every group here contains about 430 numbers, and those are the one I'm later interested in. Meaning, I want to find out something like, okay, if I have an indicator value in the extreme left, so highly negative values, does it mean something for the future? Can I derive anything out of that? And therefore I group them. In this case, I have done the exercise here for 10 groups. Later, in my other investigations, it will be 31 different groups. But remember already, they are just labeled from left to the right. And we have on the left-hand side always the highly negative or low numbers. And on the right-hand side, we have the high numbers. If we, for example, would think about power candles, yeah, that's exactly something like that. So we have 430 candles, which are extremely, not candles in this case, it's a rate of change, extremely short candles, and those are the extremely long candles, or rate of change values, better to say here. That grouping is necessary because then we can investigate those groups separately. And that's exactly what we are doing. So we know how to group, we know how to class them, to classify those. What I have finally done is I took those 28 forex pairs with those 90,000 candles, and 28 of that makes 2.5 million. And I've done the same kind of exercise, but not in Excel. I've done this in C++ in order to get those groups, and now coming to the edges. Okay, but that is when I talk about groups, when I talk about classes, that's how I derive them. And what kind of indicator you use for that? Yeah, you can use not really every indicator. For example, the EMA itself would not fit into that scheme because the EMA is just a value like the price. So we need anything which is relative, and therefore I decided, hey, I go for those 5 indicators, because those 5 indicators I can do in percent, and therefore I can compare or even totally different forex symbols. Good. And now let's go for the real searching for edges. Let me guide you through this. And on a first view, it looks crazy. A long Excel sheets. But you will completely understand what's in with those Excel sheets. And let me start with different rows, because in a second you will see the edge. First column is the indicator itself, so rate of change. Good. Then there's a column which is called future candles. What does it mean? Future candles for me is, so I want to start here with the hit rate. I introduced already the hit rate. Just looking, hey, was it a positive or a negative move? Okay, but I have to ask how many candles I look into the future. 1 candle, 2 candles, 4 candles, and I do it simply always with a factor of 2, and I end up with 128 candles looking into the future, which would mean 120 is exactly 1 week. So we have a history, and then we ask what gain we have in a certain future. Then we have a feature number. You may better think about the indicator period. Therefore, I wrote it down here. And the different indicator periods I have been investigating have been 1, 2, 4, and so on and so forth. So think about rate of change. That means here we used the rate of change 1, meaning just 1 candle, 1 hour. 1 hour back and looking for that percentage change. Then, we have done that grouping, and now we can come to the hit rates for the different groups. Here, you might think still 1, 2, but not up to 10, like in the last Excel sheet. But now I have 30 groups here. And you see already a nice number sitting here, 0.54. Let's think about what does it mean. It means we have a group which is highly negative, so on the left-hand side. So we have a rate of changes which are extremely negative, because that's this group in column H. And if we now look 1 candle into the future, we have a hit rate of 55%. What is it telling us? It means, so we have highly negative 1 candle backwards, But if we now would have, let's assume we would think about going north, that's exactly with a probability of 54%. Hey, that is already quite huge edge of 4%. And that's really good. Let's look for just one row here. And I will plot it. And then you will see the overall behavior. What is the chart telling me? Okay, group number 1, we saw already that 54. Let's go to the other side. Group number 31. Remember, 31, that is the group on the very right-hand side. And there we have indicator values which are extremely positive with high numbers. So we have huge because it's the rate of change of the period of 1. We have 1 hour backwards, we have a huge jump to the north. And now we have 46 here, or a little bit more. That is telling us for a long trade, it's 46. That would mean, on the other hand, we should go short. So we would have a very good hit with a short trade. Cool. And if you look for the values in between, yeah, they are really creating, let's say, an order. So if we don't have a change in the 1 hour history, we don't have a clear edge in the one or the other direction. It's a little bit like you might have assumed, but what you can see or draw first conclusion, counter trade is exactly what we would go for. Okay, that's just one row. Finally, let me shortly explain what means ups hit rate here. It simply assumes, okay, if we know we on the right hand side here for those values we should go short, if we know that, we can simply change the sign and then we can add all those hit rates, and therefore I call it the absolute hit rate. What is now the next column? The next row. Next row is simply a different indicator. So still we look one candle into the future, but we go for rate of change 2, which means we go look back 2 hours, 4 hours, and so on and so forth. And you can see the longer we look into the history, the numbers for a 1 hour forward edge, they go down. Okay, it's not that surprisingly, but we can see that quite clear here. And now I will only just go here until the first rate of change border. So only those values. And I will plot that column up to here. Because then we can see already quite a lot. This overall behavior that always left-hand side, lower group numbers have high values above 50%, and on the other hand, not on the other hand, and sorry, I have to restart my sentence. Sorry for that. So the longer the period we look backwards, then always it gets smaller and smaller and smaller. But since I plotted just the very left group, all the values are above 50%. So whatever indicator period I use and whatever future candles I will use, the final statement here is always the same. We should go for counter trade. That's cool. That's already quite a good statement what we can do. And now as you remember, further down here, we have all the other indicators, regression percent, range percent, and so on and so forth. Let me just put a plot here, and we can ask, Now we look for all the different indicators with always different periods and future candles. And you can already see what is the best candidate. Hey, here we have the highest numbers at all. That is the third indicator I investigated. And you can do similar things by your own. And as I mentioned, you can have those data. What is the third indicator? Range position. Wow. That's just the hit rate. And as you know, the hit rate is not everything. We have to go to the next step. Let's have a view on the percentage change. And now, overall, same thing here. Nothing really different, but the values here are now, I call them expectation value, not anymore hit rate. What does it mean? So we have an average. We go one candle into the future with the indicator rate of change 1. And now we see that if we would go, let's think about what is a move. The average move we can find is 0.01%. That's not a lot. So that's the average move we can find for the very left border group. Let me plot everything, because then you can see we can get better numbers. We can, within one indicator, that is up until future candles 128, which is 1 week into the future. So if we only look quite short into the future, of course we cannot get that high profits or high percentage changes. That's, yeah, we can understand, because within 1 hour looking into the future, there's no big change as always. But nevertheless, we see that almost everything is positive. So once again, it reflects that counter trades are the one which are the best. If we look quite far into the future, and far means 128 candles, we can really get some higher average percentage values as being the expectation value. And what I plotted here has been just all the left group. Maybe you can think about what is exactly on the other side. If I plot the very right end group. Now everything should be more or less negative, almost. And you see, indeed it is. So once again, we see that the more far we look into the future, then we get higher values. That's always this kind of behavior. There's one special indicator, regression line, sometimes really showing up here with positive numbers. But overall, hey, it works. All the numbers are more or less negative, and the longer we look into the future, the more far we look into the future, the higher is the average expectation value. But now negative. Okay, no problem for us. We can go for short rates. So if the history has been extremely positive in terms of price changes, the future is more probably to be negative, so going south. And that being done as an investigation on 2.5 million candles. Wow. So that's really a huge statistics behind. And now we can even go further, and I will jump because time is passing here. Already not percent with spread. I go directly, I will jump to real trades. Real trades means I have switched on commission. I have switched on spreads. And as you can see in the name of that Excel sheet, I have opened always long trades. Good. So normally we expect positive numbers for the very left group. And you see already, they are negative. What does it mean? Okay, that might be because here we look only one candle into the future, two candles into the future, and we saw already that we don't have that much move within 1 hour, 2 hours, 3 hours, 4 hours. So maybe we need some more hours. Only then we can compensate the costs. Although we have an edge, we need enough edge to compensate the costs of trading. Okay, then let me go down here until 128 and plot those values. And then the picture becomes clear. Okay, if we would trade all those candles belonging to group number 0, which means we have those extremely low values for the indicator rate of change. Our expectation value now in euros is always negative here for a few future candles. But if we wait long enough, like 128 candles, hey, we have an expectation value and that's euro. That's really high. So we can use that kind of information for in future to be developed trading strategy. That's really good because now we know not only that we have an edge, even if I include the cost of trading, hey, then we have still positive values. And although what I've not done here yet now is I have investigated the individual forex pairs individually. So that's still not done within the Excel sheet. And then we will find even better results because there might be forex pairs which are still not delivering us positive values here, simply because, for example, spreads are too high and we cannot compensate the cost of trading. So then the remaining average would be even higher. So that can be done just by investigating all the pairs simultaneously. And what you can see here, this is looking forward 128 candles, 64. Here we have 32, and here we have 16 candles. So it means we need a minimum trade duration of 16 candles, which is about 1 day. And yeah, so we should not go for trades which are which have a too short period of time or too short trade duration. So we need minimum 16 hours in order to really get that kind of edge. It's good to keep that in mind. So we should not look for trading strategies which have an average trade duration of minutes or just 1, 2, 3 hours. That should be too short. The conclusion is not that there does not exist such a trading strategy which works, but looking just from the perspective of those kind of different indicators, it doesn't look promising. Let's rephrase it that way. And if you look for all the different indicators, now I plot the complete column, you see a similar behavior for almost any indicator, going always for enough future candles. We really get that kind of edge. There's one indicator, and that is now once again range position. It's not doing that well for that kind of analysis, but all the others are really doing a quite good job here. And as mentioned, it's always counter trade. If we now in this long table look to to the other side here, we should not be surprised that more or less everything is negative, because that's simply not the right group for going long. If I would plot exactly the same for the short table, when I investigated all those short trades, we should find something positive once again. Indeed, we are. Good to know. So that's good. So we know that we can find not only edges, we can even transform them, or we can use those kind of edges in order to get really good profitable trading, let me call it, not already trading strategies, because it's not already a complete strategy, because I don't have stop losses. I have just looking that many candles into the future. So it's not a real trading strategy, but the concept works. And it will even be better, I can promise you, if we would do that kind of final analysis after we have found the edge, that we then go for the individual spreads, for the individual forex pairs. And then we simply would see, okay, maybe British pound, New Zealand dollar is not a good idea. But still, euro, US dollar is. So, because it might be ruined simply because of costs of trading. So let me show you on one slide the findings, just doing that kind of statistical investigation here. And I think we can draw those kind of conclusions, like the used indicators here, they really provide an edge, not only for hit rate, even finally including costs. Very good to know. What we realized as well is the extreme situations. You remember the border groups, on the very left and the very right side. They always have the best results. So we always should focus on extreme situations. Good to know. So when there's nothing in the market, we have just wiggling around of the prices. It's not a good idea to open any trade. But after we have things, huge moves in one direction, for all those kind of indicators, they would go up or extremely down. We find good situations. What we realize as well is that always counter trades is the message, really going reverse to the previous move. That is the preferred direction. It's not a surprise for me. Well, maybe for you, I don't know, maybe not. But now we have it for sure. And even when we take into account the costs, then we realize something which even good to know as well. Our typical trade duration should be not too small. Otherwise, we are lost in the noise. We are lost under the costs of trading. So we need a little bit time, because only then we have big enough moves to compensate already the costs. The good thing is that all those statements are based on 2.5 million candles. So that's really something I would call statistics. And it's not some rules based on 100 candles or 100 trades. No, 2.5 millions. So remember my first slide was measuring the precision by plus minus 2%. We need 5,000 trades. Okay, now we have 2.5 million trades being investigated in order to draw those kinds of conclusions. So that's real statistics. Of course, next step is real trading strategies based on some additional rules, like stop loss distance, take profits, for example, whatever. But that's the next step. Okay, I hope you are not that disappointed, but we have already some quite cool conclusions. So we can use that kind of approach, deriving edges, by simultaneously investigate the complete Forex universe. And the results we have seen are already quite promising. And even I have not applied any real trading strategy like stop loss and take profit, we can already conclude some important rules, especially that about how long a trade should be about. But there's more to come, and it's extremely promising, I can tell you. And stay tuned, hopefully, and we'll show results. And now, the next message: next year. Simple reason. Next week, I start on vacation over Christmas and Happy New Year. We go to Vietnam. Maybe I have a listener here, participant out of Vietnam. I'm not sure. Doesn't look from the names, but anyhow. So that's the destination for the holidays. And we have new webinars next year. But I hope you enjoyed today's webinar. And if you have interest in those Excel sheets or slides, okay, then slides could be already downloaded. But anyhow, then just drop me a note at s.friedrichowski@jfdbank.com, and I will make sure that you will get those quite immediate. But if you want, write me today or tomorrow. Otherwise, it would be too late because then I'm on vacation. That's for now. Have a good evening and enjoy your time, and see you hopefully back next year. Thanks. Bye bye.